and welcome to the Godrej Properties Limited Q2 FY2025 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Godrej Jain. Thank you, and over to you, Mr. Jain.
Thank you. Good afternoon, everyone, and thank you for joining us on Godrej Properties Q2 FY25 results conference call. We have with us Mr. Pirojsha Godrej, Executive Chairperson, Mr. Gaurav Pandey, Managing Director and CEO, and Mr. Rajendra Khetawat, CFO of the company. Before we begin this call, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the results presentation. I would now like to invite Mr. Godrej to make his opening remarks. Over to you, sir.
Good afternoon, everyone. Thank you for joining us for Godrej Properties' first quarter financial year 2025 conference call. I'll begin by discussing the highlights of the quarter, and we then look forward to taking your questions and suggestions. The residential real estate sector in India has been strong over the past few years, and we believe the sectoral tailwinds will continue over the next few years. The significant levels of business development we've executed in previous years at favorable terms continue to allow us to scale our bookings and margins, which in turn will lead to strong earnings growth in the years ahead. I'm happy to share that Godrej Properties delivered another robust quarter, registering our highest Q2 and H1 collections, operating cash flows, and deliveries. We've already achieved 51% of our annual bookings guidance. In the past 5 financial years, GPL has averaged 37% of its full-year bookings in the first half of the financial year, and in the best out of the last 5 years, we achieved 40% of our full-year bookings in the first half. Booking value in second quarter FY25 grew 3% year-on-year to rupees 5,198 crore from the sale of 5.15 million square feet of area, and booking value for the first half grew 90% to rupees 13,835 crore from the sale of 14.14 million square feet of area, which is a growth of 89% in volume terms. This strong growth can be attributed to an extremely strong customer response to some of our new launches during the quarter. Godrej Vriksha in NCR delivered a booking value of just under 1,500 crore, and Godrej Woodside Estates in MMR, a plotted development project, delivered a booking value of just over 600 crore. For the first half of financial year 25, bookings in our key markets of NCR, Bengaluru, and MMR have shown tremendous growth. In NCR, we grew 70% to rupees 5,424 crore. In Bengaluru, we grew 212% to rupees 3,889 crore, and in MMR, we grew 114% to rupees 3,113 crore. With bookings growth of 56% in financial year 23, 84% in financial year 24, and 90% in first half of financial year 25, GPL has reset its scale. The benefit of this is clearly visible in our cash flows, with collections growth of 68% and operating cash flow growth of 125% in the second quarter. GPL's collections stood at rupees 4,005 crore for the second quarter of financial year 25, a year-on-year growth of 68%, and rupees 7,017 crore for the first half, a year-on-year growth of 62%. Operating cash flows stood at rupees 1,834 crore for the second quarter, growing at 126%, and rupees 2,822 crore for the first half, growing at 204%. This is the highest ever second quarter and first half collections and operating cash flow achieved by Godrej Properties. From a business development perspective, I'm happy to announce that Godrej Properties has added 10 projects in year-to-date financial year 25, with a total estimated saleable area of nearly 14 million square feet and total estimated booking value potential of about 17,500 crore. This included 6 new projects with an expected booking value of rupees 9,650 crore in the second quarter, and 2 new projects with an expected booking value of 4,800 crore added in October. GPL has achieved 87% of its annual guidance for business development year to date. We have also entered the new micro market of Indore through a plotted development project. We delivered projects aggregating to 6.6 million square feet across 3 cities in the second quarter, taking the year-to-date total for deliveries to 9.3 million square feet. This is the highest second quarter and first half deliveries for GPL. For the second quarter, our total income increased by 135% to rupees 1,343 crore. EBITDA increased by 69% to rupees 282 crore, and net profit increased by 402% to rupees 335 crore. For the first half, our total income increased by 58% to rupees 2,981 crore. EBITDA increased by 167% to rupees 1,056 crore, and net profit increased by 345% to rupees 855 crore, surpassing earnings for full year financial 24. We started financial year 25 on a strong note and hope to build on this momentum through the launch of a large number of exciting new projects combined with strong customer sales. We also expect to deliver a record year from the point of view of cash flow and earnings. On that note, I conclude my remarks. Thank you all for joining us on the call. We'd now be happy to discuss any questions, comments, or suggestions you may have.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Puneet Gulati from HSBC. Please go ahead.
Yeah, thank you so much, and congratulations on great numbers here. My first question is, it looks very, very likely that you will exceed your booking value guidance. What should we assume that you will be aiming for in FY26?
Thanks, Puneet. Yes, I think we're on track to do well on the bookings front. We've already surpassed 50% of full year guidance, and typically the second half is significantly stronger than the first half, both for seasonality reasons and otherwise. I think the goal will be to do as well as we can this year, and then continue to deliver strong growth on that in the year ahead. So, without getting into specific numbers, which we'll comment on towards the end of the year, I think given the portfolio we've built, given current visibility on how the market is doing, I think we're all set for another exceptionally strong year of sales growth this year, and we'll look to build on that with strong growth next year as well.
Okay, and secondly, in terms of pricing, what are the trends that you're seeing in terms of pricing growth in your market? And given the realization that you've discovered, how high are they on an average compared to the pricing that you would have underwritten at?
Thanks for the question. This is Godrej here. See, essentially what we've noticed right now that there is strong price growth in especially markets like NCR and Bangalore. In fact, if I would just sort of give you a price stack-up order, Gurgaon is seeing very robust price growth over the last 2 years, but it continued even this year. Next would be Bangalore, then would be Noida. And I would say finally after we noticed Godrej Reserve launch in Mumbai, which is the largest residential sales by any developer, it's kind of also re-rated Bombay in terms of its momentum. So we are also seeing early days of good price growth in Bombay in our portfolio and also overall in the market. Pune is yet to see pricing relative kickoff when I compare with other markets, but these are sort of the stronger markets. More from a forward-looking sort of approach, difficult to finally crystal gaze, but if you generally look at where demand and supply hold, you can kind of derive certain estimates. So Noida, as you would appreciate, land supply is heavily restricted, and there is complete lack of, say, for example, 3 BHK inventory. I would say that Noida in the near term should logically see price growth action. In Gurgaon, if I were to say, I think periphery markets may not see as much of a price action, but Golf Course Road specifically should see price action because there is virtually no land supply, and finally some launches will be visible in the coming quarters. Bangalore, I think, is one of the strongest markets because the quality of land supply is limited because of the title issues of Bangalore. So whichever projects will hit the market would see reasonable growth. May not be as massive what we were seeing, say, in the preceding 2 years, but to some extent, I would say maybe high single-digit kind of numbers should be visible in the next 6 to 12 months. Bombay, I'm quite bullish personally on because this market is seeing good offtake and also pricing growth very recently. And Pune, I would say, may not be immediate as much, but say 2 to 3 quarters because Pune tends to be a lag to Bombay. And if you see Pune from a demographic point of view, very similar to what Bangalore is, so it's not taken off from pricing. So it's been a sort of a laggard, but give or take 2 to 3 quarters, we should see price growth there as well.
And in terms of compared to the prices at which you have underwritten, how high are the realizations now?
I think, I think one of the interesting things we managed to do is to do consistent, business development in the last 2 years. And purely because of the cycle benefit, we've been able to enjoy significant price expansion. To give you some sort of, broad understanding, to give an example, Sector 146 Noida, the 2 auctions that we had bought about 24 months back, we first launched the first phase last September, practically managed to sell it out in 3 to 4 months. In fact, the launch for itself was 2,200 crores. And we saw close to about, 10 to 12% or thereabouts above our underwriting level. But the residual inventory also saw price growth. But the second one that we launched, which was previous quarter, saw again price bump. So essentially, in most projects, what we are noticing, the market is giving you options. As a rule of thumb, we tend to either ensure at least that price expansion we do, or it can be higher, which means that ballpark 10 to 15% from our underwriting. In most of the parts of the portfolio we've seen, of course, there are some projects we've seen even much higher price growth, and there have been some projects which could be something slightly lower than this, but ballpark, if you ask me, 10 to 15% over underwriting is what we've kind of consistently been able to achieve.
Understood. And secondly, on the construction cash flow side, while your collections have gone up, construction outflow hasn't really gone up as much. Should we assume a significant bump up coming in the second half of this fiscal?
I think, as you would appreciate that, typically construction is more, the peak cost of construction happens to be mostly on the mid-stage and advanced, because initially your maximum cost is about, excavation, then some of these, especially the north sides, you have these piling that has to be done, which is quite time consuming, but not as capital intensive. And your construction speed significantly accelerates when you start hitting slabs beyond atypical cycles. Basically second, third, fourth slab onwards. That's when your construction tends to pick up. So yes, you're right. We will see some sort of an acceleration in COC, especially in the later part of the year. But as you would see that most of our projects we had a very strong H1, and some of these COC expenses in terms of peak would be noticeable towards mid part of next year. So starting from later part of the year, continue to the mid part of next year, you should see growth in COC curve. But, there are items like finishing where the cost tends to be higher than core and shell. There are costs related to MEP, which is also relatively higher than core and shell. And core and shell usually is higher than excavation. There's always a sort of a COC lag, in terms of cash flow, net cash flow line.
Right. Understood. That's helpful. And lastly, if you can share your share of sales booking value in the overall pre-sales.
I think we've probably shared it about 90.
First half of this financial year is around 93%.
93%.
93%. Okay. That's helpful. Thank you so much and all the best.
Thank you. The next question is from the line of Mohit Agarwal from IIFL Securities. Please go ahead.
Yeah, thanks for the opportunity and congratulations on great set of numbers. So firstly, if you could, touch base on the launch side, you've already done nearly 50% of your guidance. So, and typically second half is stronger, just like pre-sales. So if you could kind of tell us how do you see the second half and would you beat your guidance there as well? And what would be the big projects that you're looking at in the second half?
Yeah, I think, our guidance both on launches and sales always has some amount of buffers for projects slipping out for regulatory approval reasons, etc. So I think we are quite hopeful of surpassing our guidance on both counts. And the launch portfolio, I think both for Q3 and Q4 looks very full and exciting. Some of the big projects we hope to launch before the end of the year are the project in Worli. We have a couple of projects coming on Golf Course Road in Gurgaon. We have a large project in Sector 44 in Noida. 2 or 3 launches planned in Bangalore. Quite a few launches in Pune and also some in places like Kolkata and Hyderabad. So overall, I think a pretty robust launch calendar that I think gives us good confidence that we'll be a very strong second half of the year from a sales perspective.
So, Pirojsha, Worli would be 3Q or 4Q, if you could specify?
I think likely quarter 4.
Quarter 4. My second question is on, you've been acquiring land and that strategy has been working well. And it is imperative for us to replenish the sales and to grow. But assuming that, land prices have gone sharply up and probably we are somewhere near the peak, let's say, what kind of margin of safety do you want to build in your future land acquisitions in terms of margins? If you could kind of elaborate that strategy, because if, let's say, the pricing growth stunts or kind of declines, what kind of margin of safety do we have when we are underwriting the project?
Yeah, no, it's a great question, and clearly we're not at the exact same stage of the cycle now than we were about 3 or 4 years ago. But at the same time, I think, if you look at a typical cycle length in India, which has been 7 to 9 years, we're probably in year 4 of that. So we actually do think the cycle likely has 3 or 4 more years left in it. But I think the land values have gone up and to some extent kept pace with end property prices. So we do have to be very, very disciplined in terms of our land acquisition strategy. I think what we look at is that at today's price, not at any kind of price inflation or, if markets continue to do well, but just if we were selling the project today and using that price, can we achieve an IRR of at least 20 to 25% in the project? And we think if that is achievable, then that's a project that makes sense to do. We don't look at, assuming big price increases or anything when we're underwriting the project. And I think the good news is, we are seeing a lot of opportunities that are meeting this threshold. Across regions, if you look at the kind of number of deals we've done last year, and of course, if we raise any capital, the idea would be to deploy that into other new deals. We are seeing a lot of opportunities that do meet this threshold still, but I think the IRR threshold of 20 to 25% is what we look at, and from a margin perspective, we've guided that we'd like 25 to 30% kind of EBITDA margin.
Perfect, that's clear. Just one last question. You've done 17,000 crores kind of a BD, if I include the post second quarter acquisitions as well. What would be the total land spend on that, and how much of that land payment would be pending, which would come in future quarters?
So that land payment has been done in the month of October. So both inclusive of both would be around 1,000 crores.
This is the pending land payment, sir?
No. So this is for the 2 deals which we have announced post quarter end. That is 1,000 crores, and the pending land payment for the earlier deals would be around 1,500 crores for the deals which we are signing in financial year 25.
And sir, what would be the total land spend that would be in the range of 15 to 20%?
Yes.
Of GDP? Okay. Thank you, sir. That's all from my side.
Thank you. The next question is from the line of Praveen Chaudhary from Morgan Stanley. Please go ahead.
Thank you so much, and congratulations. Very, very exceptional numbers up there. I just wanted to get a sense of any overheating you are seeing in the market. And Gaurav, you went through the entire spectrum of pricing trend. It seems like everything is comfortable, but to the extent that what are you looking for in terms of any overheating or concerns in the market, either in the land price or in the final sale conditions? That will be helpful. Thank you.
Thanks, Praveen. Largely, if you were to ask me, I see a very strong demand uptake. In fact, yes, you're right, there is some chatter here and there we do tend to read. But if you ask me, purely from a ground position, we are seeing quite stellar numbers for ourselves. And early days, but even October, you would have seen some media articles of some competition also showing equally strong numbers. We, in fact, had a very good H1, not just from a growth point of view, but far higher performance than our underwriting. Now, there is of course degree of market overperformance will differ between what we saw 2 years back now from pricing and volume action. And within cities, I feel there will be sort of an evolution. So if I were to just give you some sort of a broad taste, I think I did mention some time back, periphery micro markets of Gurgaon is seeing good land supply. So we may see a volume action, but I think there will be sort of a price saturation sooner than later. But central Gurgaon doesn't really have any land supply, barring a very handful of land parks either with the government or maybe one of our peers. So that should see pricing action. Noida is practically, I already mentioned, is seeing a clear supply side issue from a launch perspective by anyone. So anything that is hitting the market is selling out very fast. I've already mentioned Bombay and the market. So I think chatter aside, if you just see what's happening on the ground and walk-ins, in fact, while the festive season has just started and there's somewhere between Navratri and Diwali and November usually is a higher momentum in my sort of history of launch that I've seen, but October is showing very encouraging signs, both by the kind of walk-ins we are seeing in our sites as well as sort of we hear from the market. So quite excited and quite strong market.
Very, very clear. Thank you so much. And then one last question for me would be, when I look at the annual sale in terms of GFA versus the land bank that you have, and I assume, let's say, 20% growth per annum, you may have 5 years worth of land bank. Is that the right way to think about it when you are going to use your cash to replenish the land bank, or do you want to have a longer land bank or a shorter land bank? Just wanted to get that sense. Thank you.
Yeah, I think in the short term, first of all, I think growth rates have been over the last couple of years much faster than that 20%. While through cycle, we do think 20% is the number we'd like to guide to. I think there is an opportunity clearly in the near term to do better than that. We've seen both last year and this half very rapid growth rates. So we think it probably ends up quite a bit less than 5 year sales, and therefore kind of replenishment is perhaps more important than it looks if you look at the 20% growth rate.
Understood. Thank you, Pirojsha. And again, congratulations. Very, very strong result.
Thanks so much, Praveen.
Thank you. The next question is from the line of Pritesh Sheth from Axis Capital. Please go ahead.
Thanks for the opportunity and congrats on great set of numbers. Firstly, again on the market environment on the absorption side, since you have had like couple of successful launches this quarter, how you read that versus what it was probably 6 months or a year back, when where projects were literally getting sold out during launch. We still have a healthy absorption rate of 60-80% inventory getting sold out, but how you read that? Is it general supply side which is creating that kind of absorption run rate, or you think that certain ticket sizes are going a bit higher and hence we are seeing some bit of cooling off in terms of response there? So just a comment on that.
I don't think we are really seeing any cooling off in our view, and there of course even 6-8 months ago it's not that 100% of projects were launching to sell out. So our view is the market remains very strong. We're quite confident several of our launches during the rest of the year will see close to sell out kind of responses. So actually we're not, there is a little bit of catch-up, especially somewhere like Gurgaon about market cooling off. I don't think what we're seeing on the sales side is really indicating that it's all to us yet, at least. And we remain quite bullish both in the very near term and medium term on the opportunity to continue this kind of trajectory.
Sure. And secondly, on the approval side of the business, have things started to recover in terms of timelines that used to take in terms of getting approvals? Because in between, like post-elections, we saw some bit of slowdown, but have things picked up from there on, or it's still as normal as it was before the elections?
I don't think we've really had much of a struggle. Of course, sometimes project by project there can be an issue, but I don't think elections had any huge impact on us. If you look at the first quarter, which was right in the middle of the elections, we had our best ever start to the year, and sales have grown 90% largely on the back of a lot of launches coming in after getting the regulatory approval. So I think from an approvals and portfolio available for launch perspective, I think we're reasonably confident that the second half will be a very strong period.
And just to build upon that, Pritesh, if you see our pipeline within, just to give you this quarter example, places like, Haryana, we've got the approval, right? Then we have projects in Mumbai and Pune, we've got the approval. So, I think what probably a learning curve for at least for us over the last few years is that these are predictable events in your sort of in a year, and you almost know during the study which quarter would be a likely time where approvals could be a struggle, is how do you become more internally efficient so that you ensure that you can apply for approvals at the earliest possible. So I think this is sort of a process change we've done internally, which is kind of ensuring that to a large extent we are able to mitigate this risk.
Sure, got it. And just lastly, on the capital raise, in terms of deployment, how much time you will take to deploy that? And second, while we'll probably reach 30,000 crore plus pre-sales, what kind of market-wise target do we internally sense, that we can generate for all our individual markets? Like NCR, we were at 10,000 crore last year. Are we working on some, market-wise targets, for other key markets of ours?
I think, we of course do have city by city and targets for each area, but it's not something that we necessarily want to guide towards at this stage. I think NCR crossing 10,000 crore last year was fantastic. On that high base in the first half, they've been able to grow 70% and have a bunch of launches planned in the second half. So hopefully we'll do even better than that this year. And of course, I think there's a healthy degree of competition internally between each of the zones, which are relatively separately managed. So we hope to see all our zones crossing this 10,000 crore mark fairly soon. And I think we have a portfolio that can get us there in places like Mumbai and the South Zone, which is Bangalore, but also now Hyderabad, where we're hoping to launch a couple of projects this year. So, I think good opportunities for growth and scale in each of these markets. And I think the sort of medium-term goal would be to establish ourselves as a leader in each of the individual markets in addition to kind of nationally.
Sure. That's helpful. That's it from my side, and all the best.
Thank you.
Thank you. The next question is from the line of Abhinav Sinha from Jefferies India. Please go ahead.
Hi, so congratulations to the team on strong numbers. First question is on with the future pipeline of new projects that we are looking at. Are we targeting the same sort of micro markets and the overall market, or you are looking to expand into newer cities?
So I think the goal is very much to expand within the cities that we're already in. So from a group housing perspective, that would be largely Mumbai, NCR, Bangalore, Pune. we're open to opportunistically adding projects in Ahmedabad and Kolkata. Just earlier this week, we added a project for the first time in many years in Ahmedabad. In Q4, we entered the Hyderabad market where we bought 2 pieces of land. We hope to launch both of those this financial year. We'd first like to just get those launched, make sure everything we underwrote is kind of playing out as expected, and then, as we'd expect, look to scale in the Hyderabad market as well. So these 5 cities of Mumbai, NCR, Bangalore, Pune, and Hyderabad are where we'd like to make a lot of our investments on the group housing side. Of course, within these markets, I think one of the opportunities is to make sure we are present in as many different micro markets as possible so that we're capturing as much of the city level demand as we can. And the only exception to this is plotted development projects where we are open to a wider range of cities.
Right. Secondly, on, I also see that some of your commercial investments have sort of reached, the maturity level. Any thoughts on how we monetize that, or, you're looking to sort of hold on to those assets?
Yeah, I think the idea is to gradually build a lead-generating portfolio for the business. I think while the lion's share of our focus for the next few years remains very much on the residential sector, where we think both the overall size of the prize is greatest, our right to win is probably highest, and the returns that can be generated, we think, are the best because of the ability to have customers financing most of the development. But at the same time, for kind of the longer term, we do want to gradually build an income-generating portfolio for the company, and I think these projects help do that. So there's no plans to sell them or exit them, if that's the question.
Right. And one last question on cash flow. So, we are seeing higher margins in the project and also higher take rates, which are now, north of 90%. So our sort of off-CFS percentage cash flow, which is now around, I think around 35%, where does it settle in, say, a couple of years?
Yes, most probably, yes.
So I think from a margin perspective, I think what we've guided, Abhinav, is on the net profit margin. We'd like to deliver something about 15% through cycle. Of course, it might go a bit higher than that when some of these projects have seen a lot of margin expansion hit revenue recognition. But I think that's kind of roughly what we're targeting. I think this OCF margin is a good shorthand thing to look at, but it's not something that we're targeting in specific margin. It actually can vary quite a bit depending on construction milestones in particular projects and things. So I think the kind of reported earnings margins we're looking at is what I indicated. And we're seeing, I think, very, very healthy growth in collection, and operating cash flow we expect will grow ahead of that.
Okay. Thanks and all the best.
Thank you.
Thank you. Next question is from the line of Parikshit Kandpal from HDFC Securities. Please go ahead. Mr. Parikshit, your line has been unmuted. Please go ahead with your question.
Yeah, hi team. Congratulations on a great quarter. So my question is on the launches. So if you can help us understand when is the Ashok Vihar launch now, and also if you can give some more color on the Vikhroli land parcel after the family settlement, how do we see it, whether new launches will happen there, and what are the timelines of launches for Vikhroli land?
I think that project, I would be hopeful that next financial year we can have a new launch in Vikhroli, and Ashok Vihar is also now looking like a next financial year launch.
Okay. The second question is on the fundraise which you have taken the resolution. So if I see the MMR portfolio, so last year's sales which we had done, the average realization was about 16,000, maybe on carpet 24,000-25,000. So we are really not there on the premium end of the MMR, which is really large and where the brand GPL can have a larger market share. So how do we intend to plug that gap on the premiumization of the MMR portfolio? Because that is what will give us bigger margin. So if you can give some more color on this fundraise and how do you intend to deploy it? Are you looking to underwrite large land parcels from maybe 50, 60 acres kind of land parcels where we can have maybe 10, 11 year kind of a development which can be premiumized? So if you can give some color on that, that would be helpful.
Sure. So I think in MMR there's already been quite a bit of premiumization of the portfolio. We have existing projects currently in the market. In somewhere like Mahalakshmi, later this year we're launching our early project. We have a project in Carmichael Road. So there are several kind of premium projects that hopefully will come to market soon, including a Bandra project that we hope to bring to market next year. But I think the opportunity is, across price points. I think something like our launch, Godrej Reserve, that Gaurav was talking about earlier, where we launched in Q4 of last year, sold brilliantly well and is a very attractive project, both from a total scale perspective as well as margins. So I think we have, struck an interesting price point in Bombay, and our goal isn't to do only luxury developments which have their own drawbacks. So, while the margin might be attractive in some cases, I think that is not necessarily the end of price segments that we're most attracted to. But I think the visibility for Bombay business development looks very strong, and we certainly hope to deploy a considerable part of any money we raise into our portfolio.
And if you see relative to our average price per square feet, I'm saying more at a portfolio level. Your portfolio is an average of markets like Pune, Bangalore, NCR, and of course Bombay. I would say portfolio average price would be much higher for Mumbai portfolio per se, because the typical presence that we have, if you see especially in the last 18 months, we've had a lot of projects apart from what Pirojsha just added. Say projects like Vatala, we have something. We have in Bhandup, we have Vistas and Vikhroli. All of these are significantly premium projects from a pricing point of view.
Gaurav, my point was more from like larger land parcels which may come up for auction or bidding, that's why some of the peers are raising large capital. So are we open to underwrite large, like 1,000 crores or 15 or 100 crores kind of single land parcels, so which can give like a higher economic interest as well as long-term development potential? Because it's hard to get land parcels, larger land parcels in Mumbai. There is limited window, and since we're raising capital, so my question was more from.
I would say that there is no reason we won't really participate in, from the angle and studio context from the perspective, I think definitely we'll participate. And I think one of the unique strengths we are having over competition, especially in markets we are present, is our ability to sign check size between 500 to 1,000 crore or even beyond if we see the opportunity is right. So of course we'll do that. The only thing I'll say, Parikshit, our length of doing this may not necessarily be what sometimes, from a check size for competition could be, say, land banking. Unless we're very, very certain about the strategy, we prefer to be more about capital churn play. Having said, we would of course evaluate any and every opportunity. But yes, we can sign big checks. Yes, we would love to scale up the Bombay portfolio significantly beyond what it is delivering. But the approach would be more about how quickly can we turn on these projects and make as much of efficient use of capital.
Okay.
Does that answer the question?
Yeah. So one question to Rajinder. So Rajinder, you touched upon that 1,000 crores pending from the BD done in Q3 and 1,500 for the rest of the. So entire land payments financial year to date for all the land parcels or pending land payments will be about 2,500 crores?
Yes, 2,500 to 3,000 crores, including Ashok Vihar and other stuff.
Okay. And just last, if I may, so how has been the approvals in Bangalore? So we have been hearing there has been significant delay in approvals in Bangalore. So if you can touch upon that, whether the approvals are coming in or things have normalized now?
I think for us, it's been coming quite consistently. Approvals in India has been a bit of a struggle, typically from last 5 years. So I won't say any market is easy or difficult relative to the trend. But we see our projects like in Q1, we were able to bring good escapes into the market, which turns out to be 3,150 crores of sale highlights for us. And similarly, we've been able to see for this quarter approvals are on track. But pressure is not very frankly geography specific. The challenge for us, it's more like a sort of a constraint which we see, and the best one can do is to ensure that, like I was mentioning, ensure that your design process are very efficient. But nothing peculiar to Bangalore for us, at least.
Okay. Thank you, team. Thanks for the answers, and wish you the best.
Thanks.
Thank you. The next question is from the line of Kunal Lakhan from CLSA. Please go ahead.
Yeah, hi. Good evening. Thanks for taking my question. Just on the fundraise, currently your promoter stake is about 50%. and post this fundraise, it could go below 50 or 47%. So what's the long-term view on, maintaining the promoter stake at?
Yeah, thanks, Kunal. I think, we'd of course not like to dilute much below the levels that we'd be at post the fundraise if we did go ahead with that. So I think the idea would be again to give a huge boost to growth. We think the kind of collections that will be generated both from the sales that have already happened, but the sales that we'd also be locking in through this new round of deployment will be frankly quite massive and will allow us to do a lot through our operating cash flow. We don't see any further reason for capital raising. Even this one, to be honest, if we were growing at the 20-30% kind of growth rate, I don't think there would be a reason for the fundraise. The growth has been much faster the last 3 years. We do see an opportunity to deliver another couple of years of very fast growth. And that's kind of the logic. But certainly, we wouldn't see any likely fundraising after this round. There's certainly no plan for any further dilution.
Sure. And on the fundraise per se, right? You did answer on the utilization of these funds, but just wanted to understand in terms of the 4 markets that you spoke about, right? Just from your opening commentary, you sounded more positive in terms of pricing. I'm saying relatively, towards like say Noida and Gurgaon versus say Bangalore, Mumbai, or Hyderabad. So should we assume that the incremental deployment of capital would be skewed towards markets like Noida and Gurgaon?
No, I don't think so. I think Kunal, one of the big benefits we think we have of having a truly national platform is that we can choose, we don't have to choose to be just in one city or the other. We can choose project by project where we think the best returns on a risk-adjusted basis are possible. And so I think we like to have that flexibility. So actually we're not raising the capital saying that 20% will be in Noida and X% in Pune or anything like that. We have a large set of opportunities available that we're seeing, in various markets. I think which of those close will depend on kind of where we're able to structure the most attractive outcomes for ourselves. But no, I don't think we're viewing the NCR market as more positive than the others. If anything, I think some of the markets that haven't quite seen that full run up in pricing yet may offer a lot of attractive opportunities. So certainly Mumbai and Pune will be very much part of the plan for this capital raise, as would Bangalore and NCR.
Very well understood. Thanks so much. One last question is, in terms of buyer profiles, especially for, Gurgaon and Noida projects, if you can give some color on, what are the profile of the buyers and how many of them typically take mortgages?
Thanks for the question. As a typical rule of thumb in most projects that what we get to see from mortgage is about typically 50 to 70% customers tend to take mortgage in the project. And, again, Noida market is always historically been more end user driven because if you see the supply itself is constrained. Gurgaon has a sort of interesting history where different participants operate, right? And I'm not talking about just right now, I'm talking more from the market condition which we've seen the evolution for the last 20 years. So you have end users who are very product driven. Then you have investors which are very long-term rental income oriented. Then you have investors which have very, sort of a thought of getting capital gain in 4 to 5 years. And then you of course have speculators who operate. I think, and different developers also tend to have a different strategy on which part of the market share they want to sort of get. If you generally see in Gurgaon portfolio, we've done some crazy blockbuster sales, but we've intentionally never pushed for a complete sold out, strategy. And the reason was very simple that we wanted to ensure that the sales funnel can try and absorb as much of end users by making certain practices which are sort of prohibitive and less attractive for investors. And simple examples are like the way we do channel incentives. They're clearly the lowest in the market. And the idea that there is no mis-selling and no, almost like not the preferred partner for some of them from a brokerage point of view, but more from a product point of view, people who want to sell a product to customers who want to stay and enjoy the property. So that's one example. The payment plans that we tend to design. If somebody wants to buy more than 1 unit, there's a sort of process defined which actually lands up to my table. And you can well imagine the probability of that reaching to me after so many approvals. So idea is to ensure that you attract the lion's share of it. And yes, sometimes, what may happen is that on the D-Day you may not say sold out, but look at Zenith as an example for us. We sold 3,000 crores in Q3, and by now we've sold another 1,000 crores at incremental pricing and better buyer profile. So I think these are things that you put in place, but yes, the market will have different types of, people who would have different types of, needs for buying out a product. Some are end users, some are investors, some are speculators. We just feel that right now the bulk of the market is there, especially different micro markets. Different, like I was mentioning sometime back, Golf Course Road, for an example, is a pure end user market, because that's the city, that's the part of the city which has complete infrastructure in place, that has probably one of the highest rental per square feet of commercial office space of North India. So it has a very different TG. But yes, if you go to 20-30 kilometers down the city, you will have different type of developers with different type of customers, investors, and the like.
Great. Thanks so much, and all the best, and a very happy Diwali to you all in advance. Thank you.
Thanks.
Thank you.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Puneet Gulati from HSBC Bank. Please go ahead.
Yeah, thanks so much for the follow-up. So Pirojsha, this one is for you. Did I hear it right? You said that if you were only anticipating 20% growth from current levels, there wouldn't be a need for a fundraise?
Yes.
So essentially with fundraise, we are targeting much higher. Okay. Secondly, can you also give a sense of what kind of gross, you've also added a significant amount of gross cash, now close to 6,000 crores, and there will be, what part would be stuck under RERA, and when do you expect some of that to also unwind?
Sorry, Puneet, can you put it with that?
So you have it's almost 6,000 crore of cash in your books now. This has grown up significantly on Q and Q. How much of it is stuck under RERA, and when do you expect it to get unwound?
So this is a continuous, RERA cash getting accumulated and released as and when the progress. As of now, we have around 3,000 crores of cash flying into RERA account, which will get utilized for the construction, and it will get released as and when the OCs will be received.
And is there
different stage for the completion percentage?
Yeah, and is there something in JVs as well which is still yet to come back to the books?
There may be some amount, but not a very significant, because now most of our JVs are at the back end or almost completed.
Okay, great. That's all from my side. Thank you so much.
Thank you.
Thank you. The next question is from the line of Sukant Garg from Equibill Research Private Limited. Please go ahead.
Hi. Hello, everyone. First of all, congrats on the numbers. I would like to ask that, in how many projects that we missed basically, in how many projects out of the total we missed the original schedule deadline?
Sorry, the voice is not clear. Can you please repeat?
Yeah, sorry. So am I clear now? Hello?
Slightly better, yeah, but it's a little muffled, but please continue.
Okay. Hello. Am I clear now?
Yes.
Okay. So I just want to ask that in how many projects we missed the original schedule deadline, and what is the average time of that miss? Average time of that, how much delay of the deadline is?
So you're basically saying what's the typical schedule timeline and how it happens in operations. That's the question?
Yes.
Got it. See, actually it depends upon quite a few factors. Like one is how big is your land parcel, because that determines the site logistics, how many basements/podiums you may want to have, and what's the typical height of the building, right? So a rule of thumb is that for a typical building, it can take as less as 3 years, can take as max as 5 years. Usually I'm saying 80% of the projects will be typically in this. Again, like the variables I mentioned to you, of course, it's more high rise. If you go to like 60-70 story, it could of course be higher, and if you go to like a 10-15 story, it could of course be far lower. But rule of thumb, you can assume that with different degrees of basement configurations and need for piling and height of the building, thumb rule will be 3 to 5 years.
So my question is around how many days of delay that we usually have in completing a project?
I would say, generally our estimation-wise, we are fairly bulk of the portfolio do not really see, frankly, sort of a typical delays. But it's also a bit of a learning for us that in some markets like, especially we talk about NCR, where National Green Tribunal has certain guidelines which have started coming the last 3 odd years, and we did of course launch projects in like 7-8 years. That time we did not envisage that there will be gap-based rule, and I'm assuming you're familiar with the regulation. So when the pollution tends to pick up, there are regulations defined when you need to kind of prescribe and halt construction. And what it does is you not only lose those many days, it takes time for you to remobilize and again speed up, right? So, but in the new projects, we tend to now budget for the time and in terms of our timeline planning and committing externally according like that. So barring aside the typical delays, I would say very handful situations we may have seen projects getting delayed, but more or less every project gets delivered on time.
Okay. Thank you. And happy Diwali to all of you. Thank you much. Thanks.
Thank you. Ladies and gentlemen, due to time constraint, we have reached the end of our Q&A session. I would now like to hand the conference over to the management for closing comments.
I hope we've been able to answer all your questions. If you have any further questions or would like any additional information, we'd be happy to be of assistance. On behalf of the management, thank you once again for taking the time to join us today.
Thank you. Ladies and gentlemen, that concludes this conference. Thank you for joining us. You may now disconnect your lines.
Thank you.
Thank you.